The West Asia conflict continues to challenge the global economy by disrupting key trade routes and supply chains, amplifying market volatility, and depressing business sentiments. Trade uncertainty lingers as US imposed fresh tariffs. The global economic environment has become increasingly unstable. Global growth is projected to soften, while inflation forecast is higher for 2026 vis-a-vis the previous year 2025. Some central banks have tightened policy, others remain vigilant. Crude oil prices, currencies, and financial markets remain volatile, fluctuating in line with the changing intensity and the uncertainties of the West Asia conflict. In this backdrop, the Monetary Policy Committee met for its third bi-monthly meeting of this financial year on 3rd, 4th, and 5th, that is today, to deliberate and decide on the policy repo rate. After a detailed assessment of the evolving macroeconomic and financial developments, as well as the outlook, the MPC decided unanimously to keep the policy repo rate unchanged at 5.25%. Consequently, the SDF rate shall remain unchanged at 5%, and the MSF rate and the bank rate at 5.5%. The MPC also decided to continue with the neutral stance. There is one measure for interest rate on advances in order to enhance transparency in lending rates and further strengthen consumer protection. It is proposed to harmonize and standardize the regulatory framework on interest rates on advances for all regulated entities. As has been the practice, I have a few additional measures also to announce. I have two measures to further strengthen the cooperative sector. One, on the basis of the feedback received on the discussion paper on licensing of UCBs, which we had done some time ago, we are now issuing draft guidelines for resuming licensing of the urban cooperative banks. Two, in light of the experience gained and the developments since 2008, when the credit monitoring arrangement for rural cooperative banks was last revised, we are issuing draft directions after undertaking a comprehensive review of this arrangement. The supply side pressures caused by the West Asia conflict have eased somewhat since June 2026, leading to withdrawal of temporary measures undertaken by the government and normalization of key input supplies. However, the re-escalation of the conflict since the first week of July has amplified volatility in energy prices and renewed uncertainty about supply chains. Amidst persistent global uncertainty, domestic economic activity has exhibited resilience as reflected by the high-frequency indicators available for Q1. Renewed tensions in West Asia, which are disruptive of global supply chains, volatility in international financial markets, and weather-related shocks, however, pose downside risks to growth. Taking all these factors into consideration, real GDP growth for this year is now projected at 6.7%. This is 10 basis points higher than our previous projections. Q1 at 7%, Q2 at 6.4%, Q3 at 6.5%, and Q4 at 6.8%. The risks are evenly divided. El Nino impact on temporal and spatial rainfall distribution continues to remain a major risk, although proactive supply management and adequate stock of food grains should provide comfort. Global oil prices have remained highly volatile, with sharp two-way movements triggered by geopolitical developments. This blurs the near-term outlook. Although generalized inflation pressures continue to remain modest so far, the risks of second-round impact of higher food, fuel, and other input prices translating to broad-based inflation persist. After considering all factors, CPI inflation for this year is now projected to be 5%, 10 basis lower than our earlier projections, with Q2 at 4.7, Q3 at 5.9, and Q4 at 5.5%. Inflation for Q1 is projected at 5.3%, with risks being evenly balanced. Core inflation is projected at 4.3% for this financial year. Core inflation, excluding precious metals, is projected to be lower than core, although it is likely to align with core inflation towards the end of the financial year.